It's time for Yahoo Finance's Market Minute. Stocks selling off, pulling back from yesterday's historic rally as the U.S.-China trade war rages on. Taiwan Semiconductor reporting a massive 42% surge in revenue in its latest quarter, driven by a boom in AI chip demand. Shares of TSMC lower along with the broader market. Taiwan Semi reports its full-year results next Thursday. And U.S. steel shares sinking after President Trump said he does not want Japan's Nippon Steel to take over the company. This comes just days after Trump ordered the Committee on Foreign Investment to revisit the deal. Shares of Trump Media and Technology Group falling after Wednesday's rally, originally getting a boost after President Trump wrote in a post on Truth Social, quote, "This is a great time to buy DJT." Shares down nearly 6% today. That's your Yahoo Finance Market Minute. For more on what's trending, scan the QR code to track the best and worst performing stocks.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, Portfolio Checkup, we discuss President Trump's latest moves on tariffs, a new inflation print, and what it all means for your investments. And financial stocks worth buying, potentially. We talked to one analyst about the bank stocks you should consider ahead of the first quarter earnings season. And finally, all week on Wealth, we're talking about home buying as we head into the busy spring season. Today, we're bringing you the guide on the closing process. You do not want to miss it. But first, we take a look at some of the market action 90 minutes into the trading day. Stocks giving back gains after an historic turnaround. Concerns about the ongoing trade war overshadowing today's cooler than expected March CPI report. Joining me now, we've got Will McGough, who is the Prime Capital Financial Deputy Chief Investment Officer. It's been a wild week for the markets so far. So how should investors be navigating this type of volatility that we're seeing here?
Hey, Brad, thanks for having me on. And you just nailed it with the word volatility. We've been telling our advisors and our clients to prepare for volatility all year, going back into January. We've got a new regime in Washington, D.C. that's obviously causing a lot of the volatility. But more importantly, we had two really good years, 20% plus back to back. So price to earnings ratios were extended to historical extremes. Earnings growth was delivering 12 to 16%. So we were really at peak growth, like there was hardly any upside left. And, the volatility has obviously been amplified by the trade wars that have started.
And so with that in mind, what is the strategy that a lot of investors would be apt in that volatility and in the valuations that were already kind of going through their own sniff tests at the beginning of the year, even prior to any type of trade war or negotiations on the tariff front being initiated?
Right. So we've been saying you should be coring up exposure. And by that, you just need to be cognizant of what your growth exposure is. The Mag 7 has a lot of concentration. It's large cap growth. It's a lot of large cap blend. So you just want to make sure that it's balanced with value dividend paying stocks to help temper that volatility. So there's a few ETFs that we've liked and used, dividend growers from Wisdom Tree, quality factor ETFs from BlackRock, to kind of help just core up exposure so that you don't want to really take too much extra risk with growth. You want to be well diversified, finally, for the first time in probably 15 years, away from the Mag 7, just simply be market weight, not overweight.
Now, globally here, how are you looking across some of the opportunities, especially knowing that U.S. stocks and U.S. exceptionalism was the trade to begin the year that we had heard from a lot of firms, but now it seems that we've seen some shifts.
Right. There's been massive shifts with the international investing landscape. You really haven't needed international exposure for the better part of 15 years. U.S. markets have dominated the world. But what we're seeing, and some friends from way back in the day used to always tell me to follow the money. So what's happening abroad is a focus on spending. We're trying to bring deficits down. Doge, we're trying to increase revenue through tariffs. So essentially, there's a tightening going on here in the States. Well, with some of Trump's policies, he's encouraging foreign countries to ramp up their defense spending. So you're seeing foreign governments in Germany and Europe, more specifically, spend more money. So if you simply follow the money flows, you're seeing money flowing out of the States and abroad, which has caused a massive divergence in performance this year for international, specifically European ETFs, versus those here in the States. So again, it's finally, you need to be diversified. You haven't needed that for 15 years with Mag 7, but there's a period going forward where international exposure, small cap exposure, bond exposure makes a lot of sense to help bring down the volatility of the Mag 7 stocks.
Specifically where internationally? I mean, especially as you have headlines now swirling around China and Europe engaging in trade talks, at least in response to some of the tariffs that have been imposed by the US.
Right. So we're specifically looking at Europe right now. Vanguard has an ETF there that we've been allocated amongst. And again, it's the European countries. It's really started with the whole Ukraine war where Trump was wanting to potentially back out of NATO, have those governments increase their defense spending, and it's been a theme that has been talked about going back to last fall, but obviously picked up more and more as we got into the year. You're also seeing the global yield curve compress too. So rates in Europe are going up, or rates here were down. They're all over the place right now. So that compression too also hurts the US dollar, which is traditionally a headwind to international investing. When you invest internationally, you get two things: the currency return plus the local market return. With the strong dollar, currency return was a detractor. With the dollar being a little weaker here, it's a helper. So that's another reason that we like being diversified internationally right now.
And then just lastly, with regard to the dollar, how do you think today's CPI print alters or at least furthers the Fed thinking in order to kind of continue with their own policy pathway, whatever that may look like at this point, because they're as reactionary as the rest of us?
Right. And if you think about past crises, 2000, 2003, 2008, 2020, the Fed stepped in. Here, you got the Fed just sitting back watching. So they're waiting to see data come in, where are rates and inflation going to go. The print today was bullish, backed up a little bit. So that may help them with their cause of not having to tame inflation, and the Fed put may come back. But I think right now, just my personal opinion is that Powell is happy letting the administration in Washington, D.C. essentially help his cause to bring market rates down, which then he'll have to react to. The saying is the bond market knows everything. And right now there's a lot of volatility in the bond market, I'd argue more than the equity markets. And with the fiscal deficits and treasury issuance that's coming, everybody needs rates to come down. And you've got Powell sitting here watching, which is fascinating. Lastly, I think he's finally right on this whole transitory phase. He was wrong after the COVID inflation, calling that transitory, but tariffs, in my opinion, are transitory, if not deflationary. So I think it's kind of a way for Powell to essentially finally be right while also trolling the media a little bit.
Will, thanks so much for taking the time.
Thank you.
Now time for some of today's trending tickers. Joining me now, we've got my morning brief co-anchor, Madison Mills. We're watching AppLovin and Levi Strauss. Important to note, both stocks are under pressure amid a broader sell-off. First up, AppLovin upgraded to overweight from equal weight at Morgan Stanley. The firm says they see it as a, quote, opportunity to buy ad tech's best executor on sale. AppLovin currently trading at around $266 a share, and the analysts see the stock going to $350 a share. That's around 27% upside from the stock's last close. Shares moving lower here, just by about 1.6% right now. We should note there is a broader market pullback off of yesterday's historic rally that we did see.
Absolutely. But I thought the headline here from AppLovin, you really can't get much better than that, calling them the best executor here. AppLovin, again, upgraded to overweight from equal weight from Morgan Stanley. Analyst Matthew Koss saying the key change is that we now see ad growth estimates as achievable. Now, they did cut estimates and the price target just to account for what else other than macro uncertainty. And the bear case now assuming a consumer-led recession in 2025. So also hearing that recession call reiterated here, despite the fact that we had that 90-day pause put on reciprocal tariffs outside of China here. AppLovin, though, still getting a lot of love more broadly across the street. If you take a look on our Yahoo Finance platform, you got about 24 buys, 4 holds, just 1 sell rating among those analysts, and the average price target is $485.08, which is keenly above the $270 level the share is currently at right now.
Next up here, we've got Levi Strauss that we're tracking, upgraded to buy at Bank of America. The firm says the company has lost a lot of they have a lot of positive boxes checked, and that those positives outweigh incremental risks. B of A has a $20 price target, representing about 34% upside from the stock's last close. Shares here, though, again, with today's broader market activity, they are trading lower right now.
I think it's really interesting that Bank of America is choosing to raise them to buy after their earnings this week. I was able to speak with CFO Harmeet Singh, and I asked him about the lack of guidance moving forward. Maybe they got lucky that they were able to get away with not offering guidance before we got a little bit more, air quotes, clarity on these tariff policies here, because obviously analysts are looking past that lack of clarity. They did establish a tariff task force internally to figure out their guidance moving forward here, because their guidance that they did issue, I should say, did not include the macro impact of those tariffs. So I wasn't really sure how I should be viewing that guidance if it didn't take those tariffs into account, because obviously this is going to have a huge impact on Levi's. They have a lot of production in the likes of China, of course, but also Mexico and some of the other countries that could be impacted by these reciprocal tariffs after these negotiations play out.
Yeah, and a major tie-in to just even in the onset of some of the tariff tit for tat and the announcements, more broadly, how this has a long-term implication on the consumer mindset. And if, the replenishment rate stays high for your jeans. I don't know how quickly people work through jeans these days. There's a lot of technical fabrics.
The Levi's, they say they last a long time.
Yeah,
so
all right, good stuff.
That's the message.
All right,
yeah.
Good to know. Thank you so much, Maddie.
Thank
Appreciate
you, Brad.
it.
Thank you.
You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. March inflation numbers are out, and overall, the report shows inflation pressures easing considerably last month, with annual core prices rising at their slowest pace since March of 2021. But there are still some sticky areas here. Here with more, we've got Yahoo Finance senior reporter Brooke DePalma. Brooke, your bread and butter, pun intended, is food retail. So give us the breakdown of what Americans are paying for their food.
Well, overall, food prices are still seeing that sticky inflation, and they're largely still experiencing a bit of the sticker shock at food stores. If you take a closer look at each index, you look at food away from home, look at food at home. We're seeing upticks across the board when it comes to year over year. We're seeing a bit of a flat line of food at home month over month, but largely we're seeing this influx. And that's largely when you look at groceries alone. It's driven by sticky inflation points from things like eggs, ground beef, and instant coffee. Those were some of the higher increases year over year that we saw within this report. So let's first start with breakfast here. If you take a closer look at egg prices, they're still up 60% year over year. It's certainly hard to swallow, especially for Americans who have been discussing eggs so much. They are up roughly 5.9% in the last month. If you take a closer look at that, just double checking here, 1.2% month over month. And then also when you think about what exactly we're seeing here is wholesale prices have been getting lower, but that hasn't really translated to stores just yet. An expert telling me this morning that higher egg prices are not really a surprise because wholesale prices are coming down in February. That then didn't roll into retail prices in March. And then ultimately Easter here, that's a bit of a mixed bag here. What exactly happens? Does that increase demand? Will that prove then more volatility? And also coffee prices, another breakfast staple there. That increased largely because we're seeing this shortage in supply, especially when it comes to one of the top markets of Brazil. They have an uncertain outlook when it comes to the supply there. Also keep in mind what happens with these tariffs. We import most of our coffee beans from, say, countries like Brazil and Colombia. Also, we're seeing milk. That's another sticky area of inflation for breakfast. Bread and cereal did see a bit of relief here, so that's good news there. But fresh fruits and vegetables also saw a decline, and largely we know that those hurricane disruptions back in the fall, that really drove some disruption when it comes to fresh fruits and vegetables. Dinner, though, if you're looking at those canned veggies and fruits, maybe don't go there because that's steel aluminum. We're seeing higher prices there. Meat, still giving people problems. That uncooked ground beef, one of the highest increases year over year that we saw. American cattle supply still low. Also, we're seeing some seasonality at work here. We're seeing a shortage in demand among beef because people are back grilling. They want to cook this beef. An increase in demand then leads to less supply and therefore higher prices.
But back to the eggs here, Brooke. I mean, egg prices have been the talk of the town for the last couple of months. Supply issues from avian flu, now tariffs, talk of Wall Street. I mean, it pops up in our feed all of the time. All we asked for was the price of eggs to come down. So what kind of price hikes could we see as a result of these tariffs? And actually, let's play this quick clip because this morning we spoke to New Century Advisors, Claudia Sam. She had this to say in comparison to egg prices.
some will say, oh, we're not going to end up collecting those tariffs. That's just ridiculous. No one's going to pay that for Chinese imported goods. It's like, well, that is a distinct possibility, but that means if in the short run we have a big pullback in the supply of goods, well, it could show up in higher consumer prices. T-shirts could be the new eggs here shortly.
So she's saying apparel prices could rise as a result of tariffs here. So what are we currently hearing from retailers, which is another area that you cover closely and watch closely, as a result of potential impacts of potential tariffs here?
Right. Well, keep in mind, China now has that more than 100% tariff on the country.
125%.
125%. That's a big pill for a lot of these apparel companies to swallow. Now, a lot of them have said that they moved out production over there, but Skechers, Nike, even Walmart continues to produce in China, import from China. And so certainly we heard from Walmart on Wednesday at their investor day that they still plan to keep prices low. That's still a goal of theirs, but it will certainly be difficult in this environment where there is a 125% increase in mind. And also keep in mind that ahead of these tariffs going into effect, there was an influx of apparel coming into the US. And that's what I'm hearing from PwC is that largely apparel companies have to offset that increase in price of bringing in these apparel ahead of the tariffs and then storing it. That extra cost of storing it in the interim also will drive prices higher. And so they said that we could see those higher prices coming to effect in early spring, early summer, despite this tariff that then went into effect just last week. And so it's definitely something to watch out for. Bottom line here, clothes are going to get more expensive because of where we ship them from.
Yeah, I want some of those tariff-free clothes. How about that?
Right.
The same way that they're marking off
US,
cars tariff-free, I want those items in the clothing aisle, perhaps, to be marked off. Brooke, thanks so much. We got a lot of track here. Coming up, everyone, first quarter earnings season about to get underway. Bank stocks leading the pack. We'll talk about the best ways to invest in the financial sector after the break. Big banks are kicking off the first quarter earnings season, and we want to talk about the ways that you can incorporate the financial sector into your portfolio. Here with more, we've got Suryansh Sharma, who is the Morningstar Senior Equity Analyst. Great to have you here with us. So let's just start with the state of banks right now. As the markets see lots of volatility around President Trump's tariff policies, how will that flow through to what we hear from the banks?
For sure. Thanks for having me. I think the tariffs, when they were initially announced, they were substantially more aggressive than what the market anticipated. And I thought what surprised the market the most was just the breadth and the scope of tariffs. So every good was targeted, every country was targeted. And I think it's widely expected that if these tariffs, we have a 90-day pause, but the uncertainty is not over. So if some sort of, these sort of tariffs go into place, it's not going to be good for the US economy. And banks are tied at the hip with US economy's macroeconomic performance. So if the economy is not doing well, the banks will definitely not do well.
What are the key areas for investors who are trying to track the banks and their metrics over the course of this earnings season that you're going to be watching for?
For sure. The most important thing is what happens with tariffs. And I think if tariffs go in place, the profitability of banks would be hit across the board. So the first thing is if we see macroeconomic weakness, Fed may cut rates faster than expected. If Fed cuts rates faster than expected, a lot of banks in our coverage are asset sensitive and their net interest margins can contract, which means that their NII could head downwards. Also, I think given the very high uncertainty that we see, loan growth can take a back seat because companies would really hesitate to do deals or expand a lot. I think after the election, there was an expectation that we are going to see an M&A boom or an investment banking boom. It seems like we're going to get an investment banking bust. So investment banking revenues are inherently cyclical. They may take a hit. We've seen capital markets correct. So if capital markets correct, not good for asset and wealth management revenues. And then finally, I think one of the biggest areas to keep in mind is what happens with provisions. So if banking as a business is just banking cycles can be very large. So let's say the banking cycle is 15 years on average. we can have 14 out of those 15 years where the provisions are less than average, and then during a recession, the provisions can just spike a lot. And I think that's what the market is worried about, and I think that's what I'm really looking forward to hearing from bank CEOs in the upcoming earnings season.
Well, we've already heard from some of those bank CEOs right ahead of the earnings, of course, as the largest U.S. bank CEO and chair, Jamie Dimon, is coming out talking about his own concerns about a recession related to some of the tariff policy that had been rolled out. So which of the banks is best positioned, and which one do you think is the top pick that investors should be considering?
For sure. I mean, just giving some context on valuation. So even before the tariff uncertainty, I think we were one of the lowest on the street with respect to our fair value estimates. For banks, we thought that, I mean, the bank valuations were already strong. The banks were out earning in certain parts of their businesses. I mean, JP Morgan was doing a 20% return on equity with very high capital levels. And this is just, extremely strong profitability, and the markets were just extrapolating it. So we were already sort of on the lower side. We think that currently the sector is undervalued, but only slightly undervalued. So I think what we are recommending clients is to be very selective in going within the bank sector. The names that we like are Bank of America in large money center banks, which is around 20% undervalued to our fair value estimate. We also like US Bancorp, which is a Whitemore traded name and around 30% undervalued, has very strong free franchise. And I think those are two names that we like in the current environment.
Suryansh, thanks so much for taking the time here with us today. We're going to be checking back in over the course of earnings. Appreciate it.
Thank you. Great to be here.
Coming up, shares of used car dealer CarMax sinking after disappointing earnings. We speak to an expert about the outlook for the used car market next on Wealth. Two hours into today's trading session, just shy of it, but very close here. Taking a look at the Dow Jones Industrial Average. We are taking a look at this day's activity right now. We're down by about 2.9%. But of course, this comes after yesterday's big bounce on the back of a social media post from the president saying that we would see a 90-day delay of tariffs for most countries that we're starting to negotiate with the U.S. However, there is a 10% tariff that is still in play. However, China has seen theirs ratcheted up to 125%. All that considered, Dow Jones Industrial Average, big day yesterday, actually record days that we had seen in terms of an end move higher, closing move higher for the Dow, the NASDAQ, and the S&P 500. But they're all lower here today, giving back some of those gains. Let's put this on a two-day view just so you can see this all in context. And so essentially now net higher by about 5.5% over that two-day trading period for the S&P 500 with today's decline factored in. The S&P 500, that is what you were taking a look at a moment ago. The NASDAQ composite here on your screen right now, there you're seeing a 4% move lower and giving back some of those gains from yesterday. And the Dow Jones Industrial Average net still higher by about 4.7%. But let's take a look at some of the heat maps that are transpiring over the course of today's trading activity here. And just want to get us on over actually to some of the sector activity that we're tracking for you, as we've got 11 S&P 500 sectors, tracking them here on the board, and we are red across the board. Pulling up the caboose though, the worst of the declines is coming in the form of energy. That's down by about 6%. Technology, the other big decliner here, that's down by about 5%. Well, why is that? I'm glad you asked. We're taking a look at the NASDAQ 100 very briefly here, and there's only a few spots of green to be found, but the mega cap tech stocks giving back some of those gains from yesterday. You're seeing Apple, Microsoft, Nvidia, Amazon, Meta, all down by around 5%. Microsoft only down by about 3% right now. In CarMax's most recent quarter, the company found used car prices rose on an annual basis for the first time in more than 2 years. The news comes as 25% tariffs are in effect on all U.S. auto imports, and additional tariffs on parts. They pose a threat to vehicles made in the U.S. So where does that leave the used car market? That's the big question. Here with more, we've got David Underkoffler, Editor-in-Chief of AutoList, a Car Guru's company. Now, let's start simple, David. How have tariffs affected the car market so far?
Well, on the used side, it's actually a little early to tell. So, we're seeing some sort of a little bit of growth in used car prices the first quarter, but that really was not related to tariffs. So it's sort of a wait and see approach to see the impact. We are sort of forecasting at this point that there certainly will be an impact. Right now, it's between 10 and 15% in terms of prices on the used car market. But I think we're a few months away before we start seeing those impacts directly. And then on the new car side of things, you're definitely starting to see some tension there. We're still at a period where many of the vehicles, or nearly all the vehicles sitting on a dealer lot right now today, were vehicles that were brought into the country prior to tariffs. So again, it's still early, but I think you're seeing consumers certainly are starting to react and sort of head to the dealership, sort of sensing that there may be changes ahead of us.
What is kind of the supply and demand equation looking like currently for used cars in your view?
Yeah, so it's sort of an interesting point right now because we are seeing late model used cars, right? Sort of the new used cars. There are actually fewer of those. And that's because we're still seeing kind of the residual impacts of the chip shortage from a few years ago, right? So at that time, there were fewer new cars coming into the market, and those would now be coming off leases. They're entering the used car market. So there are fewer of those. But net overall, there are more used cars. So there's more quantity, but what we're seeing is that there's also less quality, right? So what your dollars may have gotten you, what $25,000 may have gotten you 2 years ago, you now are getting more miles in the car and an older car for the same money today. So that's sort of a result of inflation, interest rates, and sort of the used market itself. So it sort of depends on what type of used car you're looking for.
So as you were mentioning, it means that your dollar goes less far, perhaps, here.
Yeah.
So what are we seeing in terms of the propensity to spend and what consumers are willing to pay for, and where they're saying, you know what, maybe I'll just wait for as long as I can at this point?
Yeah, so we at Autolist, we've been surveying our car shoppers since the beginning of January about tariffs and sort of how that's affecting their decisions. And we're seeing a lot of people sort of saying, you know what, there's a lot of uncertainty right now. I'm going to sit on the sidelines and sort of wait and see. So there's almost double the number of people who are waiting and seeing versus the number of people who are actually saying, you know what, I'm going to go out and get a car right now because of the uncertainty. So we would say, or my perspective would be, look, it's sort of dance with the devil right now. If there's a particular vehicle you want and you're going to need a vehicle, a new or used, in the near future, it's probably better to act now because I can't imagine a scenario in which prices for new or used decline. So yeah, that's sort of the advice we're giving people at the moment.
How is demand for electric vehicles and hybrids compared to gas-powered or internal combustion engine cars?
Yeah, great question. So for pure electric vehicles, it's a really interesting time. Sales of new electric vehicles were up in the first quarter of this year. And part of that really had nothing to do with tariffs, but it was sort of related to the Trump administration. Many people are anticipating that Trump will change the federal incentives that were brought into place under the Inflation Reduction Act during Biden's administration. So consumers, Ford and General Motors had really good Q1s in terms of their electric vehicle sales. So I would imagine that that's going to continue into Q2. On the used side, I mean, it's a great time to get a used electric vehicle. You can get some really killer deals. Sort of the incentive pricing is sort of built into the lower pricing now. So, a lot of people, if you're looking for a third car, maybe you've got a teenager in the house or just like a commuter car, right, to use during the week. I mean, $5,000, $10,000 can actually get you a pretty, accommodating all electric car. It's pretty interesting.
All these things considered, I was taking a look at a survey that was published this morning from Allison Worldwide and a poll, and they had essentially come to some of the findings here that overall the consumer sentiment and pricing expectations, they ultimately kind of painted a worsening picture for both foreign and U.S. automakers. I wonder what the manufacturing picture looks like over this uncertain period and how that will eventually impact prices more long-term, even in the used car market, if some of these vehicles that are being produced now over this next 18-month stretch, say, are going to be more expensive, and how that factors into the pricing once they hit the used lots later on.
Yeah, I mean, the ripple effects from sort of everything we're experiencing right now and will likely experience in the next several months as a result of tariffs. I mean, these are ripple effects we're going to feel in the car industry for years. I mean, earlier I was just talking about still today we're seeing the impact of the chip shortage from several years ago affecting pricing and supply and demand on the used side of the market. So I think, yeah, this is something we're going to feel for a long time. And also, it's worth making the point that not only are cars themselves facing tariffs right now, but so are car parts, right? So if you are a used car dealer, you're looking to recondition the car and turn around and sell it, your price is going up, so the consumer's price is also going to go up. So it's sort of at every stage, regardless of sort of whether you're new or used or what segment you're in, we're going to be affected by this, and for potentially years. And again, that's sort of separate from what else Trump does and chooses to do with regards to tariffs. Sort of the situation right now has already created this effect.
David, just lastly, while we have you, is there a best positioned used car dealer right now among the CarMaxes, the Carvanas of the world who go out and purchase vehicles, put their money forward in order to know that they can get a margin on the other side of that sale?
Yeah, I mean, again, this is sort of an interesting time, right? Because you're taking a little bit of any company that's sort of acquiring a vehicle is taking a little bit of a gamble, right? You're carrying the interest on that vehicle while you own it before you can turn around and sell it. And as I was mentioning, if parts pricing is going up, it creates a little bit of volatility there. So it's riskier, right? Your margins are less sure than maybe they were even 6 months ago, when you could sort of bake in sort of, the pricing expectations and the profit margin expectations were more stable. So yeah, I mean, it's a lot of overhead that companies like that are carrying, and so, like I said, some volatility that I think they're going to have to negotiate, and that's really tricky. I wouldn't envy anyone in that position moving forward.
All right, David, you've retired. You've reminded me that I have to fix the chain on my bike when I get home. I appreciate that.
All right. Thank you, Brad.
Thanks. Coming up, your step-by-step guide to closing on a home. We've got the Home Buyer's Playbook next on Wealth. Shelter inflation just rose 0.2% month over month, 4% year over year. According to the latest Consumer Price Index report, its smallest, get this, 12-month increase since 2021. Here with more is Yahoo Finance's own Danny Romero. Danny, we've been waiting for this moment because it's been the largest contributor to the All Items Index for what seems like years now at this point. So how can we expect housing inflation to continue moderating at this point, or could tariffs be an issue in future prints?
That is the big question here. There are so many unknowns with Trump's policies at play. And so taking a look at the latest inflation data, housing inflation cooled in March. And this was driven by the decline in hotel prices. This is the second consecutive month where we have seen housing costs cool. And so the government data showed us that shelter costs rose 4% on an annual basis. And like you said, that is the slowest pace since November of 2021. Now, on a monthly basis, housing costs ticked up by 0.2% last month. Now, remember, there are two components that economists pay very, very close attention to and that hold the biggest weight in the shelter figure. And that's owner's equivalent rent, OER. That's the hypothetical rent that you would earn if you were a homeowner renting out your property. And so OER came in at a 0.4% gain last month, breaking the 4-month streak of a 0.3% monthly gains. And rent, which lags real-time data because the government collects this rent data twice a year, which causes the lag in the index. So rents rose 0.3% in March. And so some economists say that shelter dynamics really vary by region and by state. And we are seeing some elevated prices in the major cities.
So if the U.S. does experience a longer-term downturn or even a recession that we've heard some economists talking about as well, how could that affect the housing market?
A recession would mean less people are unemployed, which means that would be a pullback in buyer appetite. Less buyer demand out there would put pressure on home prices. And so some economists say that some regions might see price pressures than others. Like in the South, we could see a bigger drop in home prices since there's a lot of inventory out there. In the Northeast, it's unlikely because there's an undersupply out here. So on the new home market front, home builders could pull back because tariffs will increase their material costs. We've already seen that. And lastly, a recession would lower mortgage rates, but for painful reasons, Brad.
Yeah, and the employment situation certainly is one of those. As in past recessions, we've typically seen employment pull back, and therefore unemployment rate rises, and that's a larger consideration for the housing market as well, and some of those prices you were laying out. Danny, thanks so much for taking the time. It's Housing Week on Wealth, and we have the Home Buyer's Playbook with everything that you need to know about every step of the home buying process, from the planning stages to the closing to the first year of your home ownership. So today, we're walking you through that closing process. Joining me now, we've got Tiffany Weber. Thomas and Weber managing attorney. Let's start with inspections here. What type of inspections should home buyers be getting?
The thing to know about inspections and appraisals is that most home buyers are only going to purchase a home 2, maybe 3 times in their lives. So this is not the time to skimp out. So budgeting for all of the relevant inspections are extremely important. And those inspection reports can do some important things for you, like helping you negotiate repairs. And if a seller doesn't agree to pay for repairs, at least you know what to plan for repairs that you may need to make later. Now, when it comes to the types of inspections, the most obvious one is a general home inspection. And this is something that, a home inspector will come and take a good look at the property, make sure that it's structurally sound, that it's safe, and that the main systems are in working order. Things like your heating and air, electrical systems. Those are the things that a home inspector is looking at. But depending on the property type, you may need some other things. You might need a septic inspection or a well inspection if you're not on city water and sewer. Depending on the area that you live in, radon is something that you have to look at. There could be pest, termite inspections that either are things that you decide to do, or depending on the type of loan, your lender may require that you get that type of inspection. And a property survey is a huge one, making sure that you know exactly where the boundary lines are on the property.
Oh yeah, no, that's an important one. We talked about that in my real estate law class. So an extremely important point to remember in the inspection process. Walk us through what buyers need to know about closing costs.
Yes, this is something that buyers often think they need 3 or 5% if they're a first-time home buyer of the purchase price, and that's all they need, but they're forgetting about the other fees and costs that have to be paid at the closing table. And if you're getting a loan, your lender provides you with a cost estimate very early in the process. So I encourage buyers to look at that as soon as they get it, because it will be pretty dang close to what they'll actually pay at the closing table. And you have to consider this when you're budgeting for the amount that you can pay for a home, because if you might be pre-qualified for a $600,000 house, but you only have exactly 3% of that and you can't afford the other fees and costs, then you can't close. So it helps you make sure that you're setting expectations properly when you're reviewing which houses you want to look at and ultimately what you buy.
Yeah.
And that list, the lender's estimate, is so helpful. Things that people forget about: loan origination fees, the real estate commissions if a buyer has to pay a portion of the commissions. Lenders have to get all kinds of information, and it's not free to get, like your tax transcript, your credit scores, finding out if you're in a flood zone. You have settlement fees to pay. You're paying title insurance as well. And don't forget about funding your escrow account and prepaid interest on the loan, as well as a whole year of homeowners insurance. So those are easily forgotten, and we don't like for buyers to be surprised at the closing table that they have to pay these items.
Eesh, not at all. So what are some common problems that come up during the closing process?
Usually the biggest one is failure to provide information in a timely manner. Think about it, real estate closing is a team sport. So you've got real estate agents, lenders, inspectors, attorneys, or if you're in a settlement state, a title company doing your closing, and all of those people need information. And I like to tell people that if you didn't tell me yourself, assume that I don't know. We would much rather get information twice than not at all, but failure to deliver information is a huge cause of closing delays. Another thing is, not getting the surveys. It can lead to finding out that there are title issues or encroachments that need to be resolved. So making sure that the inspections are done and done in a timely manner really helps.
So what are some tips for home buyers to avoid issues during the closing process?
My favorite one starts even before you're under contract, and it's to review the restrictions on the property. In the United States, most properties have some type of restriction. It's extremely rare that there's something completely free of restrictions. So reviewing those restrictions before you're even under contract to make sure you can use the property the way you want. There could be restrictions against certain breeds of animals, and if you've got your beloved pet and you can't move into the house with that pet, that property is not for you. The other thing is communication, like I mentioned early, and the title searches. This is something that, as a buyer, if you're concerned that there may be an issue with title searches are public record. Title searches can be completed prior to going under contract or extremely early in the closing process so that you can get ahead of potential issues and have the seller resolve them before you're running into delays or losing your interest rate lock.
Tiffany, thanks so much. Really appreciate it.
Thanks, Fred.
Coming up, it's an uncertain time for STEM majors as the Trump administration announces cuts to science funding. We get tips for navigating the environment next on Wealth. The House of Representatives narrowly passes the President Trump-backed budget bill with a vote of 216 to 214. The bill includes an extension to the 2018 tax cuts, or at least $1.5 trillion in deficit reduction as well, beefed up border security, and more. All Democrats present voted against the bill. The bill's approval was in doubt up until the vote. Some conservatives were not on board earlier this week, underscoring divisions within the Republican Party. President Trump celebrating the passing of the budget, writing in a post on Truth Social, quote, "It will be the largest tax and regulation cuts ever even contemplated." The House and Senate have to agree on the same budget bill before the president can sign it. The Senate passed a different bill over the weekend with substantially fewer spending cuts. Ahead of today's House vote, House Speaker Mike Johnson and Senate Majority Leader John Thune appeared together to project unity across the party. Degrees in STEM, that's science, technology, engineering, and math, consistently rank as the most financially rewarding college majors. Petroleum engineering, industrial engineering, computer science among the highest paid bachelor degrees in the U.S., according to PayScale. Now the outlook for these jobs in these sectors could be in trouble, as President Trump's administration has cut or frozen funding to universities that do a lot of our research and teach the next generation of scientists, doctors, and engineers. Joining me now is Dr. Peter Hotez, who is the Dean of the National School of Tropical Medicine at Baylor College of Medicine. Good to have you here with us. So what do students need to know about the potential impact of these funding cuts?
Well, there's a big attempt now to reduce the support for indirect cost to universities for particularly for biomedical science coming from the NIH, but also the National Science Foundation. Those are in the courts right now, but I think even if the courts overturn those restrictions, I think we should be counting on significant government-funded cuts to science. So then the question is, what does your career as a scientist look like in the United States? Also, the other complicating factor is this rise of pseudoscience that we're seeing coming out of the Department of Health and Human Services because of the leadership there. My article that I published in the Public Library of Science Biology, PLOS Biology, was meant to say, look, you've got an enormous skill set, particularly if you have a doctoral level degree in the sciences in terms of data analysis, ability to convey complex ideas, and therefore you should take advantage of that. Think of your doctoral degree less in terms of the specific content of what you're learning and more in terms of the enormous skill sets, and remember that you're intellectually very powerful, because there will be continued investments, particularly in the industrial sector. So, for instance, biotech investments continue to be robust, and so one of the suggestions is think about locating in one of our nation's biohubs, both the traditional ones, such as in the Boston-Cambridge area or in the Bay Area, but there's a bunch of new and emerging ones that are very exciting. For instance, here in Houston, in our Texas Medical Center, we have a big build-out in biomedical science and biohubs and biotech. Same with Research Triangle Park in North Carolina, Atlanta, Chicago, Cleveland. And there's this intricate array of not only universities and academic health centers, but also venture capital, also management consultants, and so a whole kind of ecosystem to foster that. And if we can find ways to make it more fluid, to bounce back and forth between a university setting, an educational setting, biotech, private equity, I think it's going to be possible to still very much have a meaningful career in science.
So how can students plan financially for this new environment?
Well, I think, it just may mean that the traditional route of what you've had to do in the past, getting certain types of grants to stay in a university or medical school setting, that will likely shift, so that you're going to need some flexibility and need to be able to be a bit nimble, and provided especially that we can find ways to work around some of the very difficult conflict of interest rules that currently prevent you from currently having one foot in the biotech sector, one foot in the university sector, maybe one foot in a third limb in private equity. Yeah. If we can do that, I think it's quite possible to be able to navigate their space, but it's going to need unprecedented levels of flexibilities from the universities and academic health centers that currently aren't there. But we're going to have to recognize that life will change, and rather than wring our hands and say science is collapsing, just recognizing it, maybe it's not the case, that there will certainly be tough challenges, but there are potentials for navigating this complex new world.
Professor, thanks so much for taking the time here with us. We really appreciate it.
Thank you.
Let's do one final check of the markets as we're taking a look at the major averages, and we're down across the board. The NASDAQ lower by 5% here today. The S&P 500, you're seeing that lower by about 4.3%, and the Dow Jones Industrial Average lower by 3.6%. We got a lot of time left in today's trading activity. We'll continue to see how today's pullback impacts the broader two-day average here, given yesterday's historic move higher. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up 3 p.m. Eastern Time.